Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Kate McAndrew. How you doing today, Kate?
I'm great. It's a beautiful day in San Francisco.
It's always beautiful in San Francisco, isn't it?
Yeah, we occasionally get rain and call it winter, but so far so good.
Good, good. Well, glad you're getting all the good weather. We're in Boston, and it snows pretty much all the time, so it's good. We're getting the other half of that. So, Kate, for people who don't know you, maybe you can tell us a bit about your background and how you got started as a VC.
Yeah, absolutely. So I've been in venture capital since 2012, which, oh my gosh, that's getting up there in the number of years. But I didn't start in the way that most VCs start. The typical path is, go to Harvard or Stanford, get a CS degree, go do a couple years in management consulting, and then maybe you get, a role at a big firm. And that was not at all the trajectory that I took. I actually went to McGill University in Montreal, after growing up in LA, studied art history and cultural studies, which at the time felt as far away from the business school as you could get. But I was also always entrepreneurial. I was always starting companies. I was very early in kind of the social media, kind of blogging kind of trend back in the day. So I started a consulting practice after college, kind of helping startups and medium-sized businesses, including some financial institutions, learn what the heck Facebook was, in the early 2000s. And then moved out to the Southeast to do a year of service, actually, with Habitat for Humanity, which is the last place you would go if you were trying to find a venture capital job. But in fact, that's where I found my first venture capital job. I met some retired bankers who had moved to the Southeast who were angel investors that wanted to start an accelerator program, which had been popularized by kind of Y Combinator at that time. This was, 2011. And it really opened my mind to a totally different way that knowledge and money and power could flow. I was thinking about business school where I would have to pay money to go get knowledge to start a company. But they were saying, no, no, we take money and we invest it in people who have good ideas and we help them build the business. And so from the moment that I heard that that was a thing, I said, I want to do that. And so I ran that accelerator for 2 years and then moved to San Francisco in 2014, kind of following one of the portfolio companies, and was, living in their warehouse in Soma, surrounded by kind of weirdo techies who had magnets implanted in their hands. And I was like, this is the future and I love it. And I'm here to stay. And I got my first real venture job at a startup fund. I was there for 8 years, went from associate to partner, and then started my own fund with a couple of partners in 2022. So we are now proud co-founders of a fund called Baukunst. It's a $100 million fund that exclusively leads pre-seed rounds, which is really all I've ever done. It's kind of brand new business. Half the companies we've invested in have been unincorporated when we invested. So we're really putting the first 500K to 1.5 million into brand new technology startups. And it's been a wild, beautiful ride. I love VC, and I'm really proud to be an investor.
Nice. So talk a little bit for the listeners who aren't familiar with the different parts of the cycle and where VCs come in and where they don't. If you're taking like a company from like just an idea all the way up to a company that's going public, like where's the VC's role and where are they, where's your piece in that cycle?
Yeah, so we really invest at the very beginning. And that's, I think, always been the heart and soul of what venture capital is about, right? I think from the early days, in the early 90s, VC was about putting the first couple million into a business, betting on the team and the technology, and kind of going on that company building journey with the founders. And that is what we do at Baukunst. In the 90s, it was called Series A. In the early 2000s, it was called Seed. Now it's called Pre-Seed. So the names have changed, but the really heart and soul of what the activity is has stayed the same. But venture capital exists from the stage that I invest, now called Pre-Seed, that first 500K to 2 million, all the way up to the pre-IPO phase, which is really about growth, right? And so the majority of venture capital dollars are getting deployed at Series A, Series B, Series C, Series D, and up into the IPO. But my practice, which I truly love, is the 0 to 1 phase, where it's just, as they say, like a team, a dog, and a garage, starting to build stuff, getting your first customers, hiring your first people, and making something out of nothing. So that's where I focus um, in the VC asset class.
Okay. And do you have certain sectors or areas that you primarily focus on?
Yeah, so our focus at Baukunst is really high conviction investing at the frontiers of technology and design. And I'll say more about what that means to us. I think that there's been a big sort of fetishization of technology itself, as if technology is going to solve the problems or technology is the answer. And we really see technology as the core enabling force, the core force that enables whatever it is that you're building to scale, right? That's been the absolute game changer of software. And now we're seeing it in AI. And so technology is one piece, but technology alone does not build a great company. And so our focus is really on people who have a design thinking approach to innovating and leveling up their own industries, their own tool sets. And many of them have, for us, a focus in around design, engineering, manufacturing. How do we conceptualize, make, and distribute the objects in the world around us? So everything from computer-aided design that, designs this water bottle to manufacturing software to supply chain, right? That's a big focus for us. But also taking a more abstracted view around design thinking and thinking about whole industries and how they operate. And are there more efficient ways to use technology to transform those industries in a fundamental way? So it's a really kind of interesting Venn diagram approach to looking at people, to looking at problems, and to looking at companies.
Yeah. So let me ask you, because I always imagine that the 0 to 1 phase you mentioned is more in the angel space, and the venture capitals are kind of like the phase 2, phase 3, phase 4 up to X. Um, why start so early? I would imagine there's a lot higher probability of failure at the early stage.
Yeah, the old axiom, buy low, sell high. It holds in VC too. So my perspective is that if you look at the price of equity at pre-seed, at the zero, unincorporated phase, which is where we invest, the valuations jump dramatically, usually they usually double or, triple between where we invest and that first seed round, which is where you have a product in the market, some customers, some revenue. And my belief is that between pre-seed and seed, the company matures a little bit, but it's not meaningfully de-risked for the higher price that you have to pay at seed. And so I think for myself, I love pre-seed. It's what I'm good at. It's what I've always done. So my personal reason is that I love investing at that phase. And the economic reason is that I don't believe that the risk is significantly less or is reduced enough at the seed stage, say, in order to merit the rise in price between where I invest and seed. And if you look at Series A and beyond, it's kind of a different beast, right? So I really believe that the heart of VC is this really early stage investing model. And it's tried and true. It's where the greatest alpha, the highest returns live. And so that's where, I focus my time, both because I love it and I think it's where kind of the best alpha is.
Yeah, it makes a lot of sense. So what is what's your exit strategy when you invest in a company, right? As the old adage is, you have to know how you're getting out before you get in. So how do you assess that?
Yeah, my slightly contrarian opinion is that I believe that if you build businesses that have fundamental enterprise value, you will make money, right? A lot of VCs think a lot about the exit, and it's important to understand, Is this something that we think has a high likelihood of, let's say, an M&A transaction? If it were to be acquired, who might it be acquired by and for how much? That might inform how we grow the business, right? Or do we think this has the chance of becoming a publicly traded company? If it did, what are the multiples that it might be traded at? Like those are things that we think about when we're making the investment decision. But ultimately, I think the number one thing that we need to do is find phenomenal founders who are really building strong, robust businesses that have real enterprise value in them, real revenue, right? Really good underlying metrics, strong usage, all of those things that make a good business, strong margins. And if you do that, our belief is that you will make money somehow. It'll get acquired, it'll IPO, you'll pay dividends. There's lots of ways to get your money back. But we really try to focus on great people and going long, right? Our business is a long-term investment strategy. Our fund life, venture capital fund lives are typically 10 years long, right? So in the first 3 years, we're making our investments into portfolio companies. We're kind of picking the horses, if you will. But we're expecting those horses to run for 10 years, right? And oftentimes there are extensions on that, maybe 13 years, 15 years. And so the goal is that some of those horses are so strong that they can become one, three, five, $10 billion businesses, right? And that's what venture capital is all about. It's about investing in those horses and helping them get really, really big. That's where the dynamic power law returns come in that are very hard to access in other asset classes.
Yeah. So, one question that kind of comes to mind because I know, if I hear a lot about private equity now. Private equity is like the hot button. Everyone wants private equity, and it. I've always seen that as just they're just financial alchemists. They're not really, necessarily providing value. Like some people, like you mentioned a comment, like you want to get in early, you want to help them, whereas they tend to, I guess, just look for how can we structure this and extract as much equity as possible. Um, how do you kind of assess your role as a venture capitalist in the equation?
Yeah, I mean, we are very high conviction investors. We have a relatively concentrated portfolio, which just means we're not working with a ton of people, right? And the reason that we want to invest that way is we want to be able to spend a lot of time and give a lot of attention to the entrepreneurs and meaningfully help them build their businesses. So a couple of ways that that happens. One, we take board seats or board observer seats, and so we're really building uh, a really robust structure around our relationship with the companies and helping them, be professional from the outset. We're helping recruit from our networks. Like I was just helping someone recruit a head of product, right? Everything from junior level engineering talent, but really accessing our networks to get that senior, 10x engineer, or really sometimes we're backing a solo founder. We've got to find a co-founder for them. So there's a big people component. How do you bring great people around the company? And then helping to make really good decisions around product and strategy, right? When you're starting something from scratch and you have a lean budget, there's a million things that you can do. And so mostly what you're trying to figure out is what are the one, two, or three things that I have to do, right? And if you make good decisions with that, those kinds of decisions set you up to either build the foundation of a shack, the foundation of a single family home, the foundation of a skyscraper, right? And so a lot of what we're doing is helping the founders who might be subject matter experts in, let's say, the vertical or industry that they're building in, but be first-time founders, how to think about the strategic decisions that they can make in their business from the get-go that will create a foundation for them to build a business that can scale really big. Because again, that's what early stage VC is all about.
Okay. Yeah, it makes a lot of sense. How has the industry changed over time? I mean, I've been, involved in the market since '99, and my industry's changed dramatically. How do you feel like the VC industry has changed, and where do you think it's going from here?
It's really interesting because I feel like one of the things that is hardest and most important about the work that we do is ignoring the noise, right? I think the thing that will always stay the same, that has been true, that will be true forever, is that great businesses are built by great founders. right? The number one thing that you have to do as a venture capitalist is to find the top talent, right? That will always be true. Now, the asset class or venture capital firms have tried 100 different ways to do that, right? From the rise of mega funds, the rise of, the A16Z services industries, the rise of, micro funds or alpha funds. There's a million ways that the industry has tried to innovate around itself in order to get an edge on owning big chunks of the brightest talent. But ultimately, the thing that always stays the same is that great businesses are built by great people, and you've got to find them, right? So that's the thing that hasn't changed. I do think over the 12 years that I've been investing now, I have seen a real shift in how much capital is available in the market, right? So when we had low interest rates, there was a lot of LP money or limited partner money, who are the investors in venture capital firms out there backing a lot of managers who had no investment experience. They might have operated for a few years, but there were a lot of people raising 20, 30, 40, $50 million funds. And most of those funds have been wiped out at this point or are struggling to continue to raise as the interest rate environment has changed. And also as these mega funds have taken primacy. And by mega funds, I mean huge multi-billion-dollar vehicles that are called venture capital funds, but really look a little bit more like a new kind of bank, right? And so that has totally changed the dynamics around valuations, the dynamics around how how big a company has to be successful, and the early stage option market. So things have changed a lot. But I think the number one thing to remember is that top talent will always find capital, and capital will always seek top talent. And if you do that, and if for us, it's about where is the top design technology talent, right? And in VC, you don't need to own the market, right? Like we need to find 34 great companies to invest in over the course of 3 years. That's our job. I don't need to be in every deal, but I need to be in 34 that I think have a good chance of becoming billion-dollar businesses. So I think it's a little bit of, it can be very noisy. You got to stick to your knitting, and know that my job is to find the best people.
Nice. So what does the math look like when you're running a fund of companies? Because I imagine some will do well, some won't do well. You might get some home runs, you might get some, base hits, but how do you assess that?
Yeah, so the way that we think about it is we have $100 million fund, which makes for very inconvenient numbers. And we're investing in somewhere between 30 and 35-ish companies, depending on where our average check size ends up. And again, we're investing them at the very beginning. And when we do the math of what does this company need to look like to be a fit for our portfolio, the question that we're asking is, does this one investment, have a shot on goal to return our entire fund? Which means that at the time of exit, our ownership has to be worth $100 million, right? And that's where, for us, you get the bottoms up math. If I have to believe that every company has the opportunity to be a billion-dollar company. So that's our math, right? The math has to math. We have to believe, and that, that equation is a mix of how much do we own, right? How much money did that company have to raise to get to exit? Because that creates dilution. Any money that they raise ahead of us creates dilution, right? And then what's the upside? Is it a billion, $2 billion, $3 billion outcome? So those things kind of influence that math, and we're doing that math to understand, does this have the potential to be big enough? What's really interesting, I mentioned mega funds. We have a $100 million fund. Well, if you have a $1 billion fund, think about the size of exits that you have to drive returns to your portfolio, right? And so as funds have gotten bigger, the exit value that that fund needs to see in order to be meaningful to them has also gotten bigger. And that's been a big shift and in the industry as well. So that's sort of what we're looking for. Now, do we expect that every one of those companies will actually do that? No, we don't, right? We expect that we will have Some companies shut down. And in VC versus PE, it's different. VC, we don't really worry that much about failure rate, right? We're maximizing for upside, not protecting for downside, whereas PE is a little different. So some will shut down. Some will be singles or doubles or triples. They might exit in the 3, 5, $700 million range. But for us, what really drives the returns that we're looking for, that our LPs are looking for, are those 1, 2, 3, 5, $1 billion exits. So that's kind of how we think about the math.
Okay. Yeah, that helps. It's a good understanding. So obviously there's a lot of changes in technology. There always is. AI is kind of a big whopper of a change. Although I'm of two minds on it at the moment. But I am curious to get your opinion on how AI is changing the playing field for you and what that means for some of your companies.
So I think the shift with AI cannot be understated or, underscored enough. And I think it's changing things in a couple of ways. So, number one, it is changing how efficiently one can run a business. Lots of people are out there, including, I think Sam Altman was the one who said this first, are saying, we think there are going to be billion-dollar companies with one founder or two founders and perhaps hundreds of agents doing the work that employees used to do. And so we're seeing the beginnings of that now with a lot of different founder skill shares and brown bag lunches where people are talking about how are we integrating AI into the actual operations of the startup itself, right? So we're seeing a dramatic efficiency, quote unquote, improvement on the number of dollars or in people, because people are dollars, that you need in order to build something and scale it. So that's number one. The building of the company itself is getting more efficient with AI. Number two, I think we're in a really interesting point where we're moving out of the era of AI infrastructure investment and into the era of AI application layer investment. And I forecast that, in the next year to 3 years, because this is moving very, very quickly, AI investing, quote unquote, will be the equivalent of, mobile investing, right? We won't talk about it that way anymore. It'll just be, well, if you're building a company, it's on mobile. And so today, anyone who's building anything, if I were to look at the hundreds of pitches that I get a week, whether or not they're calling themselves an AI company, they're now using an AI. They're using AI substantially in what the product is. So I think that we've moved very swiftly from big capital intensive infrastructure investing into lean AI enabled experiences, both on the enterprise side and the consumer side, that the entire VC market is now looking at. What I think is good about that, or hopeful about that, is that if we see AI just as the enabling technology, hopefully we can focus on investing in companies that are applying AI to solve people's real problems, right? So how are we using it to solve the fundamental problems of society or, businesses, consumers, et cetera? Now, not all the companies that are getting funded are doing that, but I do think that there are a lot of opportunities to think about AI in that context, and that's kind of the maybe glass half full version.
Okay. No, that's helpful. It's helpful to understand. I think it's yeah. I talk to a lot of people in AI, and you get a lot of different opinions. So I think it's a very helpful way to look at it. Um,
Can I ask you your opinion, Kirk? What are the two minds that you have?
um, I've been um a little bit older than you, not much, but definitely have seen like when the I was in college when the internet was kind of like a hot thing, like when we were day trading in the middle, coming back to class and day trading.
Yeah.
I graduated in '99, so it was a big part of kind of that era. And like you said, like it's at some point it's just becomes a thing. We don't talk about the internet anymore, just kind of what you do. But for a relatively long period of time, and like the iPhone came out in 2008, you think about like Google, I forget when it came out, it was like 2000 three or four. Like if you think about the time scale of things, I feel like on the one hand, AI is going to change everything, but I don't snap to extreme scenarios like, oh my God, it's going to change the world. Like, yeah, it probably will. So will blockchain and so all the other technologies. I think people are over their skis at this point. Like they're a little bit too far ahead. Like they think it's going to change everything. And like, it still can't tell jokes. Like jokes are my test for when AI actually has its stuff together. Because if it can't tell me a joke or a riddle, then it doesn't understand anything. And so unless it gets to that stage, I look at that as my test and like how good is it at this? Okay, when you solve that, I'll believe, all right, it's there. Because right now it's still not 100%. And I think I have a friend who's in your world, and he's starting a company for arbitration. And
Mhm.
you look at the legal world, you look at the regulatory world, there's so many fascinating applications, but I think about like when are people going to actually use it? So here's an example. So I think that we have a marketing apocalypse coming upon us in the next year or two, and people aren't ready for it. And it's been happening. It's before AI. It's been happening. AI is going to speed it up. Think about it this way. So you familiar with SEO, search engine optimization?
Sure. Yeah.
Okay. So think about that. When I go on Google and I do a search, what am I looking for? Well, I'm getting a bunch of, half-baked results based on who they think is a good website. If I go onto, ChatGPT or any of the AI platforms, I get a much better result than Google. So SEO is dead. Like, but it comes down to when it's mass adopted by people, right? It's just the adoption rate. As soon as people use AI instead, which they should, because you get a better result, then what's the function of SEO? So, I think a lot of it comes down to the adoption rate of people. Like, when are people comfortable using it? When are they comfortable with all the stuff they're hearing, like that it's hallucinating or it's giving bogus results? So I feel like the potential of AI is massive, but I think it's going to be a lot slower adoption than people think, just because of the human element of it, and the people are just getting adapted to new things. So while I see the upside and I think it's inevitable, I still think that it's maybe a little overhyped for where it is at the moment. And I think,
Yeah.
yeah,
And I think what you're putting your finger on is there's a real difference between AI in the context of broad consumer queries a la ChatGPT. There's a big difference between that and where I'm seeing most of the AI getting deployed at the application layer, which is in specialized functions, where the AI doesn't need to do everything. It just needs to do the thing that you need it to do again and again and again within your context with your data, right? And so I think that's where I think, are some time away, and I'm not going to make any predictions from AGI. But what's interesting is that for the AI to be really good at supply chain queries or training it to be a Louisiana divorce attorney or what have you, like it can get good at specific things. I don't know if I was
yeah.
just picking up the divorce. I have a friend who's getting divorced in Louisiana, and he made an AI Louisiana divorce attorney to just ask questions to before talking to his attorney.
Yeah.
Right. So anyhow, I think that it's interesting. Jury's out. We're in it, but it's moving fast, right? How fast I think is an interesting. What time will tell, right?
I think the problem is it's hard to track because it's moving so fast. Like I listened to some of the
Absolutely.
supposedly the top minds in AI, or at least the biggest thinkers in that area who've spent a lot of time and thought. And a lot of them are kind of like, well, it's either going to be utopia or dystopia. I'm not really sure. It's either going to take over. It's going to be either Terminator or trying to think of a good example of the utopia. But anyway, like I feel like they don't really know. And so, which I get, I totally understand. I mean, nobody knew where the internet would go. They thought they did, and we would all be run by URLs. We'd have a URL, and everyone would use the URL. And no, this company actually just set up their own URL. Like we don't always have the best perspective in the thick of it, but I do find that from the people I've talked to, you're right. Like the agents, the specific tasks, like the one I mentioned for arbitration, brilliant, right? Or doing medical research, like, hey, I've got this thing. What is it? Like, I could get better results now on ChatGPT than from a doctor who's been doing this for like 30 years. So
Yeah.
the applications
I,
are brilliant. It's basically an extension of big data.
I think one of the things that we're seeing is just in the last 2 years, people were saying, oh, AI is going to augment and supercharge the white collar workforce. And now, if you look at like YC's latest call for startups, they're literally saying, we're not interested in augmentation, we're looking for a rip and replace.
Wow.
So things like medical billing, right? A lot of white collar 100K a year jobs, people are looking at and actively seeking companies to fully automate those repetitive tasks. And so I think that is coming very, very fast. I personally am quite terrified by what that means for us economically, culturally, societally. Um, and I don't want to bring my politics into it, but I think if you're going all the way in on that AI future, you need to think a lot about the fallout that's going to happen culturally, societally. And, I think one version of the future is Terminator, and one future is like the solar punk future, right? Where we have, both these like, lush gardens and flying cars. And I'm kind of like, what can we make out of mycelium? Like, how do we, if we're going to lean into this technology, what are the ways that we can do it in accordance with nature? What are the ways that we can do it where we're actually building something and building towards a world that we want to live in? And I think that's a little different than the, F right, we're going to Mars sort of attitude. But I think there are a lot of people in Silicon Valley who are holding that vision and who are thinking a lot about the ways that they can use their talent, time, effort, this one precious life, as Mary Oliver would say, to try and direct us not towards a negative technological future, or not an anti-technological future, but at least one that's infused with a sense of, responsibility towards our neighbors and environment.
Yeah, it's interesting. I mean, I share your perspective there. I mean, I've been hearing people talk about universal basic income for like quite a number of years, and I was like, you're a bunch of kooks. Like that's it's just like basically communism, social. Like you people need to work. Like I think the function is like people need to actually have a purpose. You can't just sit in your couch and get a paycheck because that you don't have a purpose. Like having a purpose is very valuable. And so as soon as they started to lay out the argument with AI, I'm like, oh, now I understand where that's coming from. That was
Mm-hmm.
before people were talking about AI. Now that they talk about it, I'm like, I get it. Because I think about my industry and I mean, people still want to work with people, so I don't expect that my industry will go away anytime soon. Um, but I can see a lot of industries that will. I mean, I could see attorneys, I could see doctors. I mean, their jobs have changed a lot, where they're not diagnosticians anymore. They're just basically writing scripts. Not all of them, but it's kind of changed the profession because they're trying to be efficient and they're trying to be a business now, and it's changed a lot. So I find it is similarly wonderful and scary at the same time. I don't worry about my profession so much. I think there's some professions that are first, and then there's some professions that are kind of in the middle, and then some professions are probably last. You know, like a plumber is basically when robots, become, sentient or whatever. But certain industries will get the first hit. And I wonder, um, like my kids, like what should I push them into for a profession? I don't know. Like, I honestly have no idea what I would say. Well, if you're going to spend the rest of your life in this industry, what should it be? I have no idea. I mean, how would you think of that? Like, if you had kids and you're trying to, or you're teaching some young person, like, what industry should you get into? Like, where would you send them?
I mean, I have a 4.5-year-old son, so I think about this a lot. Now, he's obviously quite far away from, professional life, but there's a great quote. Uh, just I forget exactly how it goes, but something like if you want to teach a man to sail, don't teach him how to, pull lines and, tie knots. Teach him to yearn for the sea, right? And so I think a lot about raising a son who can take care of himself, who is kind, who takes care of his community, who knows himself. And more than ever, the timelessness of knowing oneself, knowing your morality for what you stand for. I think that needs to be the North Star more than ever, optimizing, towards a profession or what have you feels fairly short-sighted in a world that's moving this quickly. And so if you teach someone to know themselves, you teach someone to learn, you teach someone to be kind, you teach someone to evolve, right? I think those are the things that will set him up for success. Now he's also a tall white boy born to be the son of a venture capitalist in San Francisco. So he was set up with some pretty good cards. And I hope that he'll use that cards to play a beautiful hand, not only for himself, but for others. So to me, there's never been a better time to think about the fundamental principles of what does it mean to make a good human. If we lose sight of that, we're entirely screwed.
Yeah. No, I think it's a good perspective. I like that. I think it's
And by the way, I mean, I studied cultural studies and art history. So I think, part of it and what my dad said to me is he said, go study what you like and can get A's in. And that's what I wanted to do. I wanted to read, I wanted to write, I wanted to think critically, right? I was interested in engaging in the intellectual dialogue of my time. And to me, that's what was exciting. And then the way that I felt like I could have the biggest impact on it, that I could be a player, I said, we live in a capitalist society. Why did I move capital? Right? That's the way that you get to start playing the game, being a mover, right? And so I think the more that we think about the agency that we have, the tools of our agency, I mean, we bring a sense of critical understanding and humanitarian promise. I think there's a lot of things that we can do, in this life.
yeah. No, I agree with you. I think we're we're bound for a very big pivot or seismic shift in the world, and I think we all hope it's in the good direction.
I mean,
Um,
wildly, I mean, my son and I walk around our neighborhood and there are cars regularly driving around without people and, without people driving. And he thinks that's totally normal,
that's still weird for me.
right? That it's completely normal to him. He doesn't even look
Yeah.
twice, So the future is here.
It is amazing. I mean, I think you're somewhat fortunate that he wasn't of a certain age during COVID where like socially people got smacked in the head. Like my kids were around that age and some kids had it worse, but yeah, I mean, I think the amount of the speed, the thing that I fear is, I'm a Gen Xer, so I grew up, at a time where we were basically left to our own devices, latchkey kids, you had to figure things out. I saw a funny meme the other day. It's like, we survived on water from garden hoses all day. We got kicked out in the morning and we told to come back at dinner time. And maybe we were lucky to get a sandwich from somebody's house. But like that was a different era, right? And things were
Mhm.
slower and more paced. But I see things now and like things move so fast. And I'm sure the kids will adapt because the kids are very malleable. But it just makes me when I see certain things like social media, kids doing things on social media, it's cringeworthy, and you're like, oh my God, like you don't realize that this is a permanent part of your record forever, and you can't remove it. Like you have to be so careful now. Whereas when I was growing up, it's like, okay, you got reprimanded, and then people forgot about it. Now it's like permanent, and I kids don't have the perspective that we have because we've been around longer, and so I wonder how that's going to impact that generation. And I think, like you said, I think it's a good mental model to think about is just make a good kid and they'll take care of themselves. So I think that's kind of a wise perspective. Um,
Yeah, we run a 150-person collective of operators, designers, engineers, philosophers, artists at Baukunst. And one of the things that we do is we do 6 to 8 week learning sprints that we call study groups. And people self-select into learning about things that they want to learn about. And right now we're doing a study group around a book called Understanding Media by Marshall McLuhan, who's one of the top media theorists of the 20th century. We're doing it with his grandson, Andrew McLuhan, who runs the McLuhan Institute up in Canada. And one of the things that McLuhan talks about is hot and cold media. And the hotter, like a hot media moves really fast. So the hotter it is, like the faster it moves. And a cool media moves really slow, right? And so one of the things is the hotter a media is, the faster it crashes, or the faster it teaches you about itself. And AI is real hot, right? It's moving really fast. And so what's interesting is I don't think it's going to take a lifetime to really see the implications of that. I think it's going to take a decade. And the hotter the media gets, the faster it moves, the faster you get the blowback. And so I think maybe that's good, maybe that's bad, I don't know. But I think we live in a fast time, and we need to pay attention.
Yeah, I couldn't agree more. Well, Kate, we're gonna wrap it up here in the interest of time. I appreciate your time. I certainly I appreciate your opinions. And where can people find more about you and any sort of final thoughts that we haven't talked about that you think would be useful?
Yeah, absolutely. So my firm is called Baukunst, Baukunst. It means the art of building. And I'm on LinkedIn all the time. So if you want to, follow startups, startup life, venture capital, follow me on LinkedIn. I'm also on TikTok if you're a TikTok person. Kate McAndrew.
Well, Kate, really appreciate you coming on the show. Thanks for joining us, and maybe we'll have you back on in the future.
All right. Thanks, Kirk.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Kate. Really appreciate her coming on the show. Now we're into the panel portion of our show where we have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. Happy to be here. How's it going today?
Glad to have you. And you're a panel of one, so it's just gonna it's just me and you again today, Phil. We're it's a busy season, so it's hard to wrangle some people sometimes. We're gonna get a bunch of new panelists, just because people's schedules, people are getting crazy busy, which I guess is a good thing. But we need a little more variety here. So so if you're looking to be a panelist, if you're a listener to the show and you're an expert, let me know. We're looking for high quality people. We're very discerning, so we've had a lot of people come to us in the past, and we don't, accept just anybody. But certainly, if you have a background and you're interested, we're always looking for new voices, new talent, just to mix things up and give people different opinions. Ideally, we're trying to find people with the opposite opinion. It's just hard to find. So, anyway, all right. So, Phil, what were some of your thoughts about the interview today?
I really enjoyed the interview that you did with Kate. Uh, I think a lot about what the impact. I'm not a person that invests in VC. It's just not something that I do. It I know it's become more accessible than it used to be, but it's not something that I regularly do. I look at it, but I wonder a lot about the impact of the increased role of VC investing in the markets and what it's doing to the small cap space. Because historically, like if I look at small caps, you look at the long-term data, and small cap, especially small cap value, is like the best performing asset class. That hasn't been the case for a while. And so I wonder about if it's a permanent thing if it's temporary. I definitely feel like there's some fundamental changes, and we can get into those a little bit more. Um, I thought it was really interesting. As you know, I'm a value investor at heart, and I think about Buffett, and he always wants good managers, but he wants even more than he wants good managers. He wants good businesses. And when Kate talked about that, because of the state that the companies are in, she wants to have good managers. I also thought it was interesting when she said how she's looking for margins and earnings and revenue. And like it's such an early stage, and I don't often think of companies that small as exhibiting those characteristics yet because they're still building and they're not there yet. And then the other thing that I thought was interesting was when you guys kind of turned the conversation into a different direction and you started talking about like what the impact of AI is going to be on society and what type of jobs are going to be available. And, her comment about raising good humans. I thought those were all interesting aspects of the conversation.
Yeah, it was a fun conversation. I enjoyed having Kate on the show. I think she's a very thoughtful person in many ways. It sounds like as we kind of veered into the raising good humans, I thought she was very thoughtful about her approach. So appreciate that about her. It's interesting. You're talking about small caps. Let's kind of dive in there a little bit. Um, what's interesting about small caps, the small caps have been kind of, I don't want to say out of favor, but if you look back 100 years, like small caps have always outperformed at a long enough scale, large caps. Um, they're riskier. There was always the thing. I remember, I don't know, 15 years plus ago, the theory, the thing was, well, they're riskier, but they give better performance. And if you look at the late 90s, people wanted to invest in a bunch of small caps because they were, producing ridiculous returns. And of course, it was all tech, but that was kind of the thing. So I always found it interesting. And what I found interesting in probably the last, whatever it is, 10 years or so, the small caps haven't really done much. And yeah, they're up, but if you actually look at the performance, um, they've pretty much just like the S&P 500, they broke out in 2013, started to go higher. They've definitely they broke higher, and then they had a lot of sideways movement after COVID. They did well, um, in comparison, certainly. But then, hit a high right around 2021, and then it dropped, and then it back to the peak, but it hasn't really taken off in the same way like the S&P has and other indexes have. It's really kind of been lackluster, and I've been very curious about it because, I'm wondering why is it so lackluster? And, you start to dig into it and you realize, well, it comes down to a lot of factors, right? Because some of it is the dollar, because small caps tend to be more domestic, large caps tend to be more international. So it could be that. Um, it could be the fact that inflation and interest rates impact these companies more than they would impact a large company. So if you look at the Russell 2000, which is an indication of small caps, it peaked out in 2021. 2022, it dropped a lot and then came back in 2024, really. Um, and so, you look at it and say, well, obviously interest rates are very sensitive, or small caps are very sensitive to interest rates because interest rates rose, small caps went down, and as interest rates they were flatlining, it looked like, oh, well, they're going to lighten up and they're going to lower interest rates, and so small caps went up. So to me, it appears, and I'm looking at this not from a here's my opinion. I'm looking at it from a correlation standpoint because I think being correlated is really instructive to reality. It doesn't mean it's true, but if I say, well, small caps should do great because they're more volatile and thus they should get a better return. Well, that 100-year rule of thumb doesn't apply anymore. Because if it did, then they would be doing what we expect, but they're not. However, there is a high correlation in interest rates, obviously, based on this. Because um, if you look at basically when they raised interest rates, small caps dropped, where other assets did fine. They dropped, but they came back. But small caps are very sensitive because if they're borrowing money, they don't have the same depth or strength of their balance sheet that maybe a large company has. So that has a very high correlation. Now, is it the reason? Don't know. We'll never know, right? We'll never know for sure. All we know is really correlations. So I'd say, all right, that has a correlation. Um, Another thing I look at is institutional interest. So institutions can invest in large companies. And it makes sense for people to invest in Apple or the Mag 7. We'll just say, forget Apple, the Mag 7, because they're so large. So if I have a $1 billion mutual fund, I can put a chunk into Apple and it's not going to move Apple's, price all that much. And it's not going to take me a year to get in. But if I have a $1 billion fund and I got to invest in small caps, well, small cap company may only have like a $50 million market cap. Well, how am I going to put enough money in there to move the needle? It's not going to be worth it. It might have like 0.1% of the fund, so why do it at all? So I think some of the challenges is somewhat institutional based or operationally based, which has nothing to do with whether they're good companies or not. It just has to do with, can institutions justify putting money into this company? Because I go back to Warren Buffett's quote where he said if he had $500 million, he could make 50% returns a year. Now, I don't know if he could or not. I believe he probably could, knowing him. He could probably figure that out. But making 50% returns on small caps, if you know what you're doing, I think is probably reasonable. But most people don't. And I know some people play in that area, and you have to have an understanding of the markets that most people don't. So I would never want to play in that area because it's going to require things like, let's just say, for example, let's say you find a perfect company. It's great. You even know the owners, you know the financials, you're very comfortable, you know there's going to be massive growth, and they get growth and the stock price doesn't really move that much. Well, nothing you do about that because you need other people to realize this thing you realized. Or otherwise, you could have these very undervalued companies because no one knows about it, which means you got to tell everybody about it. And everyone's got to, and that's why these hedge funds go out there and they promote their book and, oh, you got to buy this company. It's great because they're trying to bring attention to their investment. And so everybody sees what they see. So now you got to be a marketer, a PR agent. It's not really just being an investor anymore. So there's a lot of things that go into this that are really important. So I'm always fascinated with small caps. I find that the bigger the market gets, the less attractive they become because there's less institutional money that can make a dent there. So it's basically individual investors. So I don't know. I don't know if they hold the same value as they did before currently because of the discrepancy in institutional money. Now, if we had a huge stock market crash where the large caps were down 50% and the small caps were down 20, well, now you've narrowed that spread. Now maybe you can make more of a dent, but I don't know. What are your thoughts, Phil?
I want to look at some different factors too. So one of the things that I think about is a lot of that small cap data goes back years, as you said. Like if we look at 100 years of return, small caps have really outperformed. But I have a client, just to give you an example. Her father bought shares of Apple 3 days after it went public. They still have those shares. Now they've changed hands through the family inheritance and all that. But if I go back to the original purchase, the cost basis in those shares is about 14 cents. And we know that Apple's trading considerably above that today. And Apple, when it went public, was a small cap. Now we have companies like, let's just use, for an example, Airbnb. It came public as a $50 billion company. So all the growth that drove those small caps, like Airbnb, it totally missed that because it came to market as a large cap. So you have that weighs against small caps because a lot of the companies that have the biggest growth potential, at least in my view, in the small cap world, as they come public, are going to be biotech. Why? Because they need a lot of funding, because they have to do a lot of R&D to develop their product and all that. It's harder for them than it might be for a tech company to get funding. So that's one thing that's weighing on them. The other thing is that I get a newsletter from Ed Yardeni. It's called the Daily Briefing that I get, and I actually asked him this question too. And one of the things that he pointed out is that because of the fact that there's not new companies coming into that small cap arena. A lot of these are old companies. They've been around for a long time. If they've been around for a long time, probably the chances of them really exhibiting that growth are probably not there. And then if we look at some of the indexes that the small caps are in, you have like the Russell 2000 that you mentioned. I know that's what most people think of as a benchmark. That includes a lot of companies that don't make any money. And so it kind of distorts the valuations. If you want to get like just earning small caps that are earning money, you look at something like the S&P, the small cap 600. And I pulled up uh, one of the newsletters from Yardeni this week, and he has value, he has growth, and he has earnings for the S&P 500, 400, which would be mid caps, and 600, which would be small caps. And so, like, well, look here, the small caps are testing their 17-week lows, right, which were set during January, in mid-January. The large cap, I mean, that their average PE right now is 22.2, which is only half a percent below its 43-month high of 22.3 from the December 6th. You know, mid caps, their forward PE is 15.6, and small caps, theirs is 15.3, and you wouldn't expect that. That's like seems the opposite of what I would expect. And if you look at the earnings, like it's the same thing. Like the growth that is expected from large caps is actually higher than for small caps. Like it all seems distorted from what we've historically come to expect. And I think a lot of it is because of the fact that the venture capital investors are holding on a lot longer. Companies are coming public a lot later. And so the original founders and the early investors have a lot more opportunity to benefit because the companies don't need the funding. It's coming through, you know, the VCs. It's even coming through mutual fund companies like T. Rowe Price and Fidelity. They invest now in venture capital companies. They didn't used to do that. I mean, I worked for T. Rowe Price at one point in time. We couldn't invest in those back then. Now they can. So there's a lot of things that have changed. So I wonder about small caps and if the and think that the long-term trends are less likely to hold. And therefore, like when I've looked at my client portfolios, I actually have made a downward adjustment in my small cap allocation because I'm concerned that we're seeing a fundamental change in the small cap market.
Yeah, it's interesting. I mean, we're talking about a lot of like similar things here, which is basically the markets have changed fundamentally. And if you look back, I think one of the challenges with Wall Street is we like our rules of thumb, right? We like our kind of tried and true. We talk a lot about them in the show. We should probably bring them back out this year as the myths, um, the Wall Street myths, which is like, oh well, cash is trash, is what Ray Dalio said. Well, no, cash is king in the right timing, right? It's trash if you hold it for 100 years, sure, but I don't know a lot of people who do that. So, I think the challenge is how do you challenge these age-old rules of thumb? And I think what you have to do is you do have to challenge them. Because if you think about some of these rules of thumb, like small cap are more volatile and risky, but they'll get a better return. Okay, well that may have been true, but as Phil said, things have changed, right? And we've talked a lot about why fundamentally things have changed. Um, and also things go through cycles, right? Like Timberland was one of the best performing asset classes if you were doing an institutional level. Like Harvard was making like 37, 38% a year from Timberland until it became more widely available to like the retail side. And then it just kind of got watered down, and people realized what the Harvard found endowment was doing. And then they actually, there's some stories behind this. I think, what's his name? Summers? Is that, yeah, I think it was former president. He just basically fired a bunch of those guys, and they were like, all right, well, we'll go on our own. And they were getting paid like no money, like they were getting a low salary, and someone's like, we don't need this, we don't need to pay them. So they brought in other people, paid them a lot more, and these guys went out and got paid a ton of money to keep doing what they were doing because what they were doing was highly valuable, and they were making great returns. But the point being is they were doing something that very few other people are doing, but when everybody figured it out, the returns just flatlined. Same thing with hedge funds. Hedge funds were great back in the day, and now everyone's doing it. Now it's hard to get good hedge funds. All these different asset classes go through these cycles, and I think the challenge is that most people are set in their ways and they do one thing and they only do it and they never think any outside the box. And the problem is, what if your box shrinks and you can't see that because you're only in your box? It's like we're talking about the small caps. Small caps used to have a thing. Hey, it's more risky, as Phil said. He's reducing his allocations to small caps. We don't even have an allocation to small caps because I just, unless there's a, I look at small caps as well. If there's a strategic value to it, we'll do it. Otherwise, what's the point? Um, so I think, you know, my style is a little bit different. I'm not an allocator. Most advisors are just allocators and they just, put it and leave it. But I think if you don't understand how the markets have changed, as we're talking about here, then you're not going to understand why you're underperforming, right? So if you're a value investor for the last 20 years, well, I'm sorry. That's all I can say. I'm sorry. It wasn't my fault, but I'm sorry. you know? Um, because value's been out of favor for many different reasons. And I think what we have to realize is if things change and you don't, that's the problem. The problem isn't that, oh, well, we were in the wrong asset class. The problem is that things fundamentally changed and you didn't realize it. And you're still doing the same thing. It's what's the definition of insanity? Doing the same thing over and over and expecting different results. And I think that applies here in some ways, because if you're investing and expecting value to do well, next year it's going to do well. Next year it's going to do well. 20 years later, all right, it's going to happen this year. No whammies. Like, that's not really a great way to invest. Now, it might be fine if you're okay underperforming every year as a value investor. I'm not saying you shouldn't be, right? Because that has merit. I'm, by my nature, a value investor. I'm just not investing in value stocks because I know they're out of favor and I'm not really touching them. But it's it is a style. It's a style that can do very well if you know what you're doing. Um, but you shouldn't expect to beat the index or the Mag 7 because you're in a different league. You shouldn't expect to beat crypto. Maybe you're okay with getting, 5, 6, 7% returns. That's fine, right? If that's what you want, then what's wrong with that? There's nothing wrong with that. So I think it's just really figuring out, like, have things fundamentally changed? And does it still warrant investment in those areas? So obviously we're talking about venture capital with Kate. Venture capital is kind of this interesting area where it got hot with tech, and it's kind of stayed hot. It hasn't overheated. Like PE's overheated right now. Way too much money flooding in there, kind of like hedge funds in the late 90s. Everyone wanted to be in a hedge fund. So much so that it watered down the industry, and now everyone has one, and now you can't get into the good ones. I feel like private equity is kind of going down that road where it's just they can get access to money, so they're just buying everything they can, even though it doesn't make sense. I've seen a lot of business models, private equity is getting in, and it should make money, but it doesn't because private equity they're just, they've got money and they're spending it, and they're not always making a profit. But venture capital seems to kind of fall in this little Goldilocks zone where they just kind of do their thing. It's sexy enough, but not too sexy where you've got money flooding in there and making it too messy. So, like people like Kate and others, I've met a bunch of venture capitalists. They just kind of crank away and they do it because they're in that part of the cycle. Um, and so it's a fascinating niche to me. But the question is, should you invest in it? What are your thoughts, Phil? Should investors listening to the show be investing in venture capital, or how should people be looking at this as an asset class?
So before I get to that, there's one thing I want to address too, is when you talked about value, like I'll bring up something Buffett said again. Like, look, the distinction between value and growth, in some ways it doesn't make sense. When you buy a stock, it should always be a value, right? You should always be thinking that it has the opportunity to appreciate. And nobody wants a company that doesn't grow at all. So it's just the way that we like traditional value, that's what's really underperformed, but there's still opportunities to find companies that are good values. As far as venture capital goes, I tend to think it's not the place for the average investor. I know I don't do it. That doesn't mean that can't, and it doesn't mean that just because I say that I don't do it doesn't mean anything for anybody else because we all have to do our own research and make our own decisions. But if you want to do it, I think it's one of those things that you say, okay, I'm going to take X% of my portfolio, or that be 1%, 3%, 5%, 10%, whatever it is. I don't think I'd ever go above probably five, but say I'm going to put 5% of my portfolio into those type of investments if I have access, right? Because that's the other thing. You can't just say I'm going to invest in venture capital. You have to be able to have a way to get to it, a way to access it. But just say, this is a small portion of my portfolio. I'm going to put it into venture capital and that's it, and not mess with it. And you never, unless that's all you do, right? Like Kate, maybe her portfolio is all in venture capital because that's what she does. And she has a lot of knowledge and she has a lot of insights and everything else. But for the average investor, if you want to invest in venture capital, I think the best thing to do is say, I'm going to take this X% of my portfolio, and that's going to be for venture capital. And that's all I'm going to do. And I also know that if I lose that money, I go in knowing that I could lose it because there is more risk because not every venture, not all the VC investments turn into something. So I have to be willing to lose it and also know that it's not going to be money that I can easily access because once it's in venture capital, it's not like you can say, okay, I put my money in, it went up X%, I want it out, or, I'm not happy with how the investment's gone, I want it out because usually money's tied up. So you have to understand that you've allocated a specific portion of your portfolio to this type of investment and be willing to know that that's also at risk.
Yeah, no, I agree. I agree. I think it's, you know, it, what's going to be really interesting going forward, and I know we kind of talked a lot about AI in the interview as well, is the impact of AI on different types of companies, different market caps, different, whatever. And I think um, it was a good conversation with Kate because I am fascinated with AI and its impact on different companies. Because if you think about like small cap, for example, um, small cap is much more sensitive to some of these changes than like a large cap. So for some of these large cap companies who are trying to implement AI into their companies, the CEOs have been talking about lately and how it's not actually going to move the needle for them. And they're getting frustrated because they're spending like a lot of money on this and it's not really changing much. Now, I look at it and I see, like my wife works for a Fortune 500 company and it's um I hear the conversations that are going on about AI. It's like, and I hear like clients who work for Fortune 500 companies and like I hear these conversations that the internally companies are having like should they do it? How should they do it? How's this going to impact jobs? Like there's a lot of scope that goes into this because everyone's trying to reduce cost. But, what do? Do you fire employees and hire AI? Well, maybe in some instances, but AI is not at the point yet where you can just say, "All right, go do it." Right? You have to manage it and you have to understand how to operate it. I was just watching a show called Person of Interest, which I have to say I give I don't know if this is coincidence or deliberate, but when I see like Hollywood put out shows that are way ahead of their time, and you're like, how did that happen? So like this show, Person of Interest, is basically about these people going around saving people, but it's based on an artificial intelligence that is determining when someone's at danger of being killed. And so this guy they run around the city and they save people, and it's a really well done series. If you're interested in that sort of thing, I loved it. It ties everything together. It's very well. It's like 5 seasons. It all ties together. It's really cool. Anyway, so I was watching the show in the last few weeks, and I'm looking at it. I'm like, this is just so interestingly spot on for a lot of this stuff. I'm like, how did they get it so right? Because it was started in 2012, 2011, 2012 when it came out. How is it that accurate? Like 20, like 12, 13 years ago, 14 years ago. How is it that spot on when AI is coming out now? Like, how did they get it so accurate? And so I'm just fascinated by all this stuff. So makes me wonder with corporations, how much of this is going to apply? I think it's going to take longer. As Kate and I talked about, I think she's probably smarter in this topic than I am. I'm more of a hobbyist in this, but my opinion is I think things are going to take a lot longer to apply because I think companies are trying to do it and they're not quite getting it. They're using it, but it's like what's the value here? But they don't want to be behind. It's like ESG. Oh, we're ESG friendly, or we're this, and we're green friendly, and now we're in crypto, and now we're in AI. It's like we're in everything because we want to make you happy as shareholders. I feel like that kind of goes on because now it's that Trump got in. Oh, we're against ESG. ESG is terrible. We're not doing that, right? So it's kind of like this. It's like Zuckerberg who went on the Rogan show and came out and said, "Oh, I didn't like when the government was telling us what to do." I'm like, really? Because uh, I think if you came out during the Biden administration and said this, I would have given you a lot of credit for that. But now you're coming out after and saying, "Oh, there's nothing we could have done." It's like you don't get any credit for coming out after when it's safe, right? You don't get credit for that. You get credit when it's hard, right? That's what leaders are about: is doing things when they're hard and when they're risky, not when it's easy. Anyway, point being is, I think a lot of big companies tend to be trendy. They tend to go along with the trends. What I'll be interested to see is if small companies start to adopt this and get a lot of growth and margin expansion because of it. That would be really interesting to me. So far, I've heard of a lot of things that are happening, but they're not quite out yet. So I feel like we're on the cusp of some really interesting stuff. Like I was talking to one guy who was telling me that in the legal system they're trying to do AI arbitration, which I think that's kind of a little difficult. You're relying on a AI to come up with the right answer for arbitration. It's like, what if they're wrong? What are your because it can be wrong. It's not right 100% of the time. So it's little things like that. It's kind of like, are people going to accept it? Right? Are people going to say, oh, well, yeah, of course AI is right. No, they're not going to say that. Like, screw you, AI. I didn't like your outcome. So, and to take it a level deeper, so what does that mean for AI? So let's say, for instance, we build this AI and it's perfect, right? And we say, all right, AI, how do we solve the world's problems? Okay, and it comes up with an answer. And we don't like the answer. Or it somehow disadvantages a certain part of society. What are we going to say? Screw you, AI. You're wrong. I'm not going to listen to you. You're obviously wrong. Even if it's right, we're going to say it's wrong, and then we're gonna trash the machine and the Luddites. And human nature is a weird thing, and human nature is such that we don't like our ego to be impacted, right? We have a view on the world that we think is correct. None of us have it correct. We have a more or less correct version, but we don't have 100% correct version. We just have our opinions. Like we're built on opinions based on our experiences. So if AI comes up with a solution that we don't like, we're going to say you're wrong. So what value is AI if we're just saying, nah, you're incorrect because we didn't like it? I don't know. I mean, these are deep questions that I think need to be addressed, and I don't think people are really talking in that way yet, but I think at some point we will, because we'll realize that, well, maybe it's right and we're wrong, but we're not going to accept the answer, so we need to find a palatable answer for AI to give us that we will accept. And then it's like, well, it's just a reinforcement loop, right? We're reinforcing our own, we're in our own echo chamber, right? We're reinforcing what we already think. It's why people on the left read the New York Times. They watch MSNBC and CNN. The people on the right they watch Fox, and they read other things that are associated with that. It's because we want people to talk about things that we think are correct, so that we feel we're smart. If you're on the right, go watch MSNBC and CNN and try really hard not to shut off the TV or yell at it. Right? It's hard, but in some ways, that is the best thing you can do because you're looking at the other side and you're saying, all right, what am I missing? And you have to sit there and take it and not have it like mess with you. It's hard for most people. They're like, wait, what? Like, and because their brain implodes because it's somebody else's opinion and you want to be comfortable in your own opinion. So it takes a smart person to really sit there and it's I don't want to do it. It's painful. So, but sometimes the best thing you can do because it opens up your mind to other ideas that maybe you haven't thought of or haven't fully thought through. And sometimes you can change your mind. Most people won't because it's not how your brain works. But if you can, well, that's interesting. So I don't know. We're going to wrap it up here soon, Phil. But what are your thoughts on AI?
So first, I would just want to follow up on what you just said. I mean, that's confirmation bias, right? Like we want to
Mhm.
find opinions that agree with ours because then we think we're right. And so it's really important. Like when I think about investing, I want to find somebody that's taking the opposite view because I want to understand what that is. Because maybe they know something that I don't, or maybe they point out something that I didn't think of, and I want to make sure that I look at things from all sides. I think it's really important. Social media has made this so easy too, right? We can go find these groups on social media that agree with our point of view, and then we just read what they say, and then it just reinforces, and we never understand the other side. And like you said, it's important to understand both sides, and sometimes it can change your mind. Uh, and it just increases your knowledge and your understanding. As far as AI, I mean, I think it's fascinating. I love to read AI. There's certain ways that I use AI. I think that one thing you didn't mention, like on the business front, like my wife also works for like a Fortune 500 company, but they are a government defense contractor. So they can't use AI the way that some companies can because they're really afraid of things being discovered, found, whatever. Like I remember they're not allowed to have TikTok on their phones there if they have applications for because the company won't let them. So there are some things that there are some places where it's going to be harder for it to apply because we don't know how protected, how safe the information that we put out there is. And look, we put a lot of information out there. There's a lot of things that people could find out about you if they want to. But AI itself, I mean, like I said, there's ways that I use it. I read about it a lot. There's companies that I invest in that are benefiting from AI. I'm really curious to see where it goes. Like we hear about all these industries that could go away. I tend to think, I mean, you talked about it a little bit during the interview. I think that it's a lot harder for it to hit our industry in some ways. And one of those is that there's no personal interaction. And I think that's such an important part of what we do. It's not just all about numbers and reporting things. And so AI, I don't think it can totally replace that. And yes, I know that there's AI models that can talk to you and everything else, but it's not the same as having a conversation with a human being that can have, that can really interact with you. And you said talked about telling jokes, right? Like, does AI really do that? Like that part of it's missing, but I do think that there's a lot of ways that it can have an impact on our businesses and on our lives. And I am really curious to see exactly what comes of all this. And like I said, I just think it's a fascinating topic that I'm always looking for more things to read and learn about it.
Where can people find more about you, Phil?
Uh, I'm Phil Weiss. My firm is Apprise Wealth Management. I know experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm is Apprise Wealth Management. We'd love to get to know you. You can go to our website, which is Apprise Wealth, APPRISE wealth.com, and sign up for our weekly blog or schedule a free introductory call. Thanks for having me today, Kirk. Enjoyed the conversation as always.
Yeah, thanks for coming on, Phil. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.